All right, welcome everyone. As you're coming in, we'll give everyone just another minute to shuffle in, and then we'll get started. So thanks for joining us again. Obviously, there is a lot going on in the world, in Washington, and a really lot going on with potential tax changes. So we're still digesting information, and of course, nothing's in stone, but things are starting to formalize where we can look at it, give you some insight, and then of course things will change. So we'll probably do another one of these. We've kind of changed our format on our live webinars, where every other week we're going to do one of these, which is more of like a real timely update on like what's going on with something important: financial, tax, investment, markets, economy, etc. And then the other half of the live webinars are going to be more on different subjects of like building your financial future or learning something that's really important. And so it's going to flip back and forth. So check that out. You can, well, I'll actually show you real fast here. Let me go ahead and get started here. Turn on my presentation so you can see my screen. And you may have already seen this, but if you just go to our website, even if you just Google us, rebelfinancial.com, there's a little thing up here for webinars. You can see what's coming up. Sometimes you'll see where there's a gap inside of there. It's because I haven't actually picked the topic because I want it to be really timely. So these are the ones that are more learning, and you can go back and look at all of our old ones. We've done a lot now. Look at all those, and a lot of them are real good. I've spent a lot of time on these. So check them out. Again, thanks so much for joining us today. So let's go ahead and dig in. Today, we're going to talk about a lot of the tax changes that are happening, proposed, and being implemented, like the tariffs and what. So what are the effects? How are they going to commingle? Who's going to win? Who's going to lose? And of course, we don't know all the answers, but we're going to give you some insight to where things are now, because we have to wait for the politicians. And of course, no one really knows what they're going to do in the end, right? So just really when we look at the TCJA, that is the legislation that went in 2017, the Tax Cuts and Jobs Act, that pretty much across the board gave a lot of tax cuts to people, of course, more towards the higher end and business side of things, but still was pretty much broad-based across the board. That's going to expire this year, and so everybody's scrambling around to say, do we let it expire? Do we renew it? Do we do something different, etc.? Okay, so if it was to go away, it would actually raise or save us on the debt, however you want to look at it, 4.2 trillion. I've seen 4.2 to 4.5. It just depends on who's doing the estimate there. But with this part of it, it's a huge thing. Okay, so let's keep driving on here. So what are the core provisions that you may care about, or a lot of people care about? And so first was it lowered the individual tax rates, and I'll actually show you the tax brackets as they were adjusted to inflation and as they are right now, so you can get a check at that. It gave higher standard deductions, try to simplify the taxes. Before it was exemptions and deductions, and I'll show you the difference there. Expanded the child tax credit, created a thing called qualified business income, where there's a 20% deduction for qualifying businesses on their personal returns. They kind of threw that out there so that they weren't just giving a tax break to huge corporations and not, regular Main Street mom and pop. And so that's what the QBI was for short. That's what we call it. The SALT cap, I don't know if any of you hit that. That just says for state and local income taxes, you can only deduct up to 10K, which is, as I noted here, being contentious for residents in high tax states if you're a high taxpayer, right? Because you may have 20-some thousand dollars and you can only deduct 10, right? So that one has been, there's a lot of proposal on that. So who knows which way it'll go, you'll see. So let me dig in here. And again, if you want to throw your questions out there, put them in the chat and I will try to hit them as we go, and or save them up to the end. if there's too many, and I think it's going to stop me from finishing. So feel free to throw them out there. I find it's best to do when I go to conferences and stuff. Just got back from one. I'll usually write a little question thing and write my questions down as soon as I have them, because it's really easy if there's a decent presentation for you to forget about it by the time you get to the end, even though it might have been a great question. Okay, so this is what we're looking at now. So this is where taxes are right now for 2024 versus if we had the pre or post TCJA tax brackets inflated to the same numbers. And so I took this from kitsos.com. Check him out. He's a great guy. I borrow stuff from people all the time, but I try to give him a plug just so that they get the credit for the work that they did do, etc. I actually just saw him yesterday as well. So anyhow, you can see the tax brackets here. What ended up happening is they went down about 3%, for the 12 and 22 brackets right here. And then they expanded a little bit higher on the 22. And then this was probably the bigger cut right here, 4%. And of course, that went a lot higher, almost $100,000 higher. And I am looking at the married filing jointly, but you can see both, whichever one you want to look at. And then, then we go back to more 3% cuts. And then the 35 goes a lot higher, and it used to go up to almost 40, and it got stamped down to 37. So what would end up happening is we'd flip back to these for those ranges of adjusted gross income. Okay. And so for most people, that's a 3%, tax decrease on this amount. I mean, if you're lower, then it's going to be less than that because the 10 didn't really change. Right. So again, it was weighted a lot more when you start to get up at the 28. So folks that are generally making more than $200,000 is who's benefiting the most of this, and then extra things for like business and what so. Okay, so the next thing I wanted to look at was deductions versus exemptions, because a lot of people are like, well, the standard deduction is going to go down a lot, but one thing that they're not really taking account of is that before it was deductions plus exemptions, right? And so you used to get the smaller deduction plus $4,050 per person, okay? And so you would be able, like, here's an example: a family of four, where you got two parents, two kids, could deduct $16,200 or 4 times that from their income, in addition to their standard or itemized, if it's bigger, deduction. And so generally larger families benefited from that, and you can actually have gone up under the new system, even though it's technically simpler, right? And so here's an example just so you can kind of see. So if you're a single filer and you don't have a dependent, then you save more with that bigger standard deduction. If you had one, then you actually had an increase or decrease of your taxable income under the old with the exemptions. Now, of course, there's a 3% different tax on that. And so it really takes you maybe up to 2 or 3, where you get to 2 or 3 here to where it actually comes out to where you get more. So people, with, a couple kids or what, so, especially down here, you're starting to get to where you're getting better off under the old way, if we're only looking at this kind of very single variable, right? Okay, so I like to put that out there just because a lot of people just think that with the lower deduction, they're not going to do as well, and that may not necessarily be the case. It is a lot for somebody that's just single, not claiming anybody else. That absolutely did help you. Or if you're married, have no kids or anything like that, did help you, and it was simpler, right? But again, it's not a huge impact from that perspective, but it is something that you should understand, and hopefully now you do. So again, throw your questions in there if you got them. We're going to keep going. Okay. Next slide. The one thing that I think is very interesting is that how much extra it's going to cost just to extend this. And a really cool thing that we could do is extend it for everybody, like say under that $400,000 number. And look how much money it saves us. About $2.4 trillion in savings if we extended it for everybody under 400,000. That's AGI. That's adjusted gross income, after you get all these deductions and everything like that. And it would save us that much money. So it's just an interesting thing to look at, to understand where a lot of the tax savings and costs are in these things. So keeping on moving on. Now we start looking at the new tax cuts that are coming up. And since I named it how I did, I'm just going to start out from when we look at this, how much on average, not taking in the TCJA, if it would go back or forward or anything, but just the new things that they're talking about. And it's like the average, middle income person might save about $1,000. But if you're in the top percent of a percent, then the average savings is projected to be over $300,000 in tax savings. If you're lower income hitting the top of the poverty level, maybe 500 or so. So we're not talking about much here for the average regular person in the United States. These are not huge stakes here. Now, are there winners and losers? Always. There's a huge spread, and there could be somebody lower income that really comes out ahead, because of some of the changes and what they do and what area they work in, which you'll see with some of the individual proposals that I'm going to review with you. Okay, so I do like to look at this because you can kind of see where we're going budget wise. Okay, so you can see through the 80s up to the beginning of the 2000s right here. We were running a little bit deficit, and then by the end of Clinton time frame, we were running some surpluses, right? And then kind of going back the opposite way, and then of course, we get into some more war and different things, and then 2008, 2009, extra spending and stimulus, start to try to get ourselves back together and maybe running a responsible budget like we should as a family or as a person. And then of course, COVID. And now we're looking like we're not going to get right. Like this is like the new normal that we're going to spend a lot. And so you can see where we're at right now. And if we pass all the stuff that we're talking about over the next 10 years, we're going to add an additional 10 trillion. Okay. So we are definitely accelerating the deficit. It's already gone way past, what, people 10 or 15 years ago were talking about, that the markets and what so would handle. And if we keep just doing what we're doing without even anything bad happening, like COVID or 2008, 2009 again, or a war or something like that, right now we're at about 100% debt to GDP. By 2054, we'd be at 214%. So that's wild. I mean, if interest rates were, any kind of higher with that, the interest expense on that would be horrific. Okay, so let's keep going. House strategy. So we're going to talk about the House and the Senate, and it seems like the House is getting more on board with the Senate's version of things, but still I'm going to outline it for you. And so you can kind of see the House was proposing another 4.5 trillion in tax cuts over the next decade. But one of the things they were really trying to push through and do was like, hey, we got to save like 4 to 5 trillion in actual like budgetary cuts, or find savings, or increase something else to give a tax cut over here. And so they were being pretty, relatively compared to the Senate's bill, relatively disciplined about it. They wanted to make the TCJA permanent and then focus on some of the middle class and business incentives, which would be cool. Relatively. Again, I don't know necessarily that we need more tax cuts considering where we are debt wise. You're kind of getting my drift of how I feel about it personally. But anyways, if we're going to do it, you'll see another thing where I show you like how much gains, like wealth and income wise, have been unequally distributed the last couple decades, that if we're going to do it, we might as well be helping the middle class and small businesses the most if we can. The Senate strategy is a little bit more in tax cuts, about 5 trillion. But the big thing that they're doing was they're counting all the extensions like the TCJA as like cost neutral. It's not going to cost us anymore. They were already there, right? No, they were going to expire. That's what budget reconciliation is. When you don't have a majority to really get over the filibuster, you have to limit it to 10 years. It was going to go back, but through accounting type things and political spin, they're just going to say these things don't cost any extra. And they're a little bit more aggressive on the corporate cuts if we're just going to summarize. Okay, so feel free to throw your questions out there. Now we're going to, or where they're different. So like I said, kind of the Senate's more on the accounting trick side of things. Be very difficult to save $4 trillion in cuts or by increasing something else, et cetera. We even have a little discussion of how much tax money the tariffs might be able to raise or no, in terms of spending caps and what they might be able to do to come up with the numbers that they're trying to reach to make it sellable to where they can get enough votes. Okay. And there's potential for gridlock, if they don't get along. It does look like the House is coming around to where the Senate is. And then the real question becomes, can they get over, filibuster, get somebody else on their side, or are they straight up majority and they're looking again at another budget reconciliation or like a 10-year, kind of Band-Aid versus a permanent tax law change. Okay. So I already named some of these, but if the TCJA didn't extend, I'm just going to a little bit more of the things that are in there. Okay. So we would return back to the old tax rates, which, as we said, are a little bit higher, especially more on the higher incomes scale. We would switch back to the lower standard deduction with the exemptions, the child tax credit. Now, even if this would have, let's say, like if the Democrats would have won the last election, they probably would have let it expire, but they probably would have kept this. So, even if they didn't do a lot of these other things, I would hope they keep the child tax credits inside of there, maybe even the pass through, because they did make the corporate tax rate cut permanent. That would not have sunset regardless, right? And so one of the other things we're talking about, they're going to cut corporate taxes even more inside of there. It would make the SALT cap go away. And then right now, I didn't put this one in this one, but if you see a pass of my couple, I go over a lot of the estate tax in the past and what it's been and how much we've lowered what the actual tax is and how much you're allowed to give away tax free. And we're pushing well over 20 million now. Okay. And so it would make it go back to the lower levels before that was increased to that much. And then the AMT doesn't affect that many people. The alternative minimum tax, it tries to catch people that for various reasons or what so are maybe not paying as high a tax as they should. And so the way that it works, it seems very unfair. It's like you calculate regular taxes, you calculate AMT taxes, and whichever one's higher, you have to pay. Okay, so for most people, especially below a couple $100,000, you're not going to have to deal with this. But it would impact more people because it would go back to the old rules inside of there. And then, of course, without any extensions, that QBI that I was talking about earlier would go away as well. Okay, so moving on, some people might find this more interesting. It might have been what you showed up for. But the new things that are coming through that probably have a pretty good chance of being enacted is lower taxes. Additionally, just like I was doing the that estimate on who's going to win or what so probably more lower taxes, especially towards the higher end of the brackets. Lower the taxes on corporations from 21 to 15%. This one's a real wild card because something's probably going to happen. We just don't know which one. It's like all over the board. There's proposals to say, let's just keep it what it is for the TCJA and keep the 10K. There's some people say remove it, allow unlimited, deductions for SALT. There's some people say, all right, let's keep it, but let's raise it to 15 or 20K. I even saw another one where it's like, all right, 10K for single, 20K for married, right? So we really don't know what's going to happen with that, but probably one of those four scenarios. Bonus depreciation was going away. So if you bought a heavier vehicle for your business, you could deduct it faster as a business, and that was kind of going away, and that is going to probably stay and get revived. There were certain corporations that spent a lot on R&D that lost the ability to accelerate deductions for research and other things. And of course, I think that's going to be reinstated. This one could be a negative for people because there's just it's very politicized. Roll back that Inflation Reduction Act, a lot of the clean energy credits, but there's just a lot of businesses that have benefited from this, like even like Tesla and different ones that are closer to the administration where they could just be like, all right, let's just get rid of it for people and leave it for the businesses. Well, that would be crummy, right? If you're going to get rid of it, regardless if you're friends with so-and-so. And if you're going to keep it, let regular citizens benefit from solar or whatever as well, too. Okay. But something will probably happen here in some way, shape, or form. Now, I call these the wild cards. Okay. And so these are really interesting to people, but who knows what will actually happen. Okay. Because this is where you could really lose votes. Or what so, and some of them could be very expensive. So you can see this tax-free Social Security. So make Social Security checks 100% tax-free. Really, this would probably, I put in here, have a limited stimulative effect because most retirees, they're getting their Social Security, they're living off of it. It's at worst 80% taxable, so it's not even fully taxable. And the lower income you are, the less taxable it is. And so they're going to give this tax benefit would hit the higher or the higher earning side of Social Security people more. And most of those people have retirement accounts. And so if they have retirement accounts, then if they need more than what's in Social Security, they're just going to withdraw more from the retirement account. So if you just give them more money back from their taxes, they're just going to withdraw a little bit less from their retirement. So it's not really going to be that stimulative. Most seniors are a little bit more fixed income. They're going to spend what they're going to spend. So anyhow, I'm not against it or for it or whatever. I'm just giving you the backdrop of it. Tax-free tips, so it's possible. It was funny. I was just at a conference and I saw David Kelly, and he is one of JP Morgan Chase's main economists. And he was like, it's probably not going to happen, but who cares? Who's paying taxes on tips anyways? Right? Maybe where they're getting swiped sometimes, and that's getting taxed or what so. But still, this is not a huge thing. Now, could it create a lot of cheating and people being upset for fairness or what so? I heard another accountant say, well, how can we take advantage of this? How about we just do everybody's taxes for free and then just ask for tips at the end, and we won't have to pay any taxes either. Right? So you can see how this could turn into a conundrum. And I was just listening to a Wall Street Journal podcast this morning where they're talking about like most Americans think that tipping is out of control. What do you think is going to happen if tips are tax-free? Everybody's going to want to get paid in tips. It's going to be horrible. So anyways, it may sound good, especially if you're a service worker or been a service worker and you got a soft spot in your heart. It's probably not the best thing though, but we'll see. It was a promise. It could happen. Tax-free overtime. So make overtime work 100% tax-free. That's a big one. That's a lot of money. That would be expensive running up on the deficit or what so. And it would affect not that huge amount of the population. It'd be kind of a niche toss out. I'm sure they would appreciate it a ton, but we'll see what happens there. I think these ones are the ones that are more populist and people like, even though this one would be bigger. One that's out there, this could happen, tax deductible car loans. So if when you take out a car loan, just like if you took out a mortgage, the interest part of it would be deductible. I think they're trying to make it only for U.S. manufactured cars, though. Oops, let me go back. I need to do that. So that would be a big one too, and that could also be very expensive, depending on what happens there. Looks like we got a question. Let me check it out. Oh, maybe you retracted it. Oh, no, there we go. It says Trump has even teased that he could look to remove income taxes on people earning $200,000 or less. Does that seem remotely feasible considering the deficit? You know what? With everything that's been going on, I don't take anything off the table anymore. There's a lot of things that have happened that I did not think, could or would happen, and they're going forward. And so that's actually possible. And I mentioned that I got to meet and talk with Michael Kitces yesterday, And that's actually one of the things that we were talking about. And he thinks absolutely that could happen. And you know what? When I really think about it, most of our taxes are not going to come, from the lower middle income class and lower middle income class or lower. Okay. And especially if we start seeing that there's more AI and automation and et cetera, then it's going to become less and less and less. So, within the next 10 to 20 years, the writing's on the wall that that's not really where the tax revenue is going to come from. So, I mean, it would actually be like kind of implementing it early. But like, what are we doing it for? Are we doing it, to buy votes and what so? Are we doing it, to help people and try to make the system more equitable? Because if we add a bunch of, or if we take away a bunch of taxes from the middle and lower income socioeconomic class, but then we add a bunch of tariffs or VATs or national sales tax that's very regressive to them, you could still end up taxing them more than what they were paying before. So, who knows? Is it possible? For sure. Is that really on the table right this second? I don't think so, but we'll see, right? Okay. Eliminate head of household. And so right now, you can claim this filing status where, let's say you got kids, but you're divorced or widowed or, whatever the case, and you're better than just filing singly, right? But we take that away, and then you'd save them like 190 some $billion. Man, but that'd be pretty crummy for, single moms and dads or, whatever the case where you're able to claim that, right? Eliminate the American Opportunity Credit. So right now there's a $2,500 credit if you don't make too much money, for the first it's supposed to say 4 years of undergrad expenses. So it's a pretty cool, benefit for those that qualify for it, and they probably need it with how expensive college is. So that would suck if it went away, but that almost saves them, $100 billion if they could get rid of that. Remove the estate or death tax. So totally, beyond extending how high it is now, let's just get rid of it, which would be a real big toss out to the top, because right now you can already pass, 20 some $1 million without any estate taxes. So not many people that are watching this or whatever are going to pay that or even know somebody that's going to pay that. And so just removing it is kind of wild. Okay, so who benefits most? So high earners definitely going to benefit from the new tax cuts beyond, going past the TCJA extension. So, it's become kind of a popular thing, to make that line kind of at 400K, for a married household of like high earners versus middle class and everyone else, right? And so I would say if you're over that threshold, you're going to win some more. And the farther you're over that, probably the more you're going to win. And this kind of doubles down on that. Corporations are absolutely going to win some of the actual tax things inside of there, like the R&D I was talking about, the bonus depreciation, the lower tax rates. And then, of course, a lot of them are owned by a lot of the high earners. So it's kind of a double whammy there. Now, possibly retirees and overtime workers, right? So we threw that out there. As well, I think they could, if those were to go through, be winners as well through some of those. So then we talk about the tax cuts and how much it's going to cost, and people will be like, wow, the tariffs are going to pay for everything. It's like, all right, well, let's look at that, okay? And so when we look at the conventional estimates that you see in the news, they're just talking about, hey, if everything just kept going, we just put a tariff on there, how much money will we make, right? And it's like, well, with a 10% flat, which it's back down to now temporarily, we'd make 2.2 trillion over the next 10 years. And so again, it's kind of a drop in the bucket versus 10 million extra in spending. So it's definitely not going to pay for it. But if you actually come down and look at it, you're like, okay, we really haven't seen the sticker price. And of course, I think there was a big tiff yesterday almost, between the administration and Amazon, because Amazon was going to put a thing on there that put the tariff costs on there to say, here's the price, here's the sales tax, here's the tariff costs, here's your total price. And then the administration went right after him and said, you can't do that, you're politicizing and blah, blah, blah. And the Amazon backed right down. But again, that's what we're talking about here. If you go to buy something that used to be $100 and now it's $140, there's a decent amount of, you're just not going to buy it anymore. It's too expensive. 100 was, I was thinking about it. I saved up for a while. Goes to 140. I think I'm good without it. So you're going to lose some of that demand when those lower cost products go away. So it's not going to be that amount. And then if everyone retaliates against us, it's going to take it down even more, because then we're going to lose from selling to other people as well too. So again, kind of when I was listening to David Kelly the other day, the economist from Chase, he said tariffs are pure arsenic. There are much better ways to raise revenue that are direct and not as inefficient and like draining as this from the global economy than tariffs. You go to 15% and you can see that same math. And I just like skipping to this 20 because it's like, all right, if we double it, we should make double the money. But that's not how it works. And especially if you get retaliation, you barely get a 50% bump. It's definitely diminishing returns here. The more you go up, that we're just losing out of production and efficiency, etc. Okay, so continuing on, what's the pros and cons, just so you understand? Because there's a lot of people saying, hey, this is the new thing. We're going to make all our money from tariffs. And probably not. Okay. And even if we could, would we want to? So let's look at this. So the benefits of tariffs, tariffs make foreign goods more expensive, obviously, right? Because we're going to add a tax onto them, and it gives local companies a pricing advantage. And so ironically, even though most companies can keep their prices the same that are local and they would win really easy, most of them end up raising their prices and actually taking advantage of the tariffs to just make more money. Helps fledgling industries. We did this a lot earlier in our country's establishment, and still other developing countries need to do it if they want to have, be able to have their own steel production or whatso, instead of China dumping on them and not being able to have their own industry, right? Generate government revenue, absolutely does, especially in developing nations that don't really have any other places that they could tax, like broad-based income bases or existing wealth, etc. And then we already saw how much these things could raise. And of course, if you're only going to use it as a negotiating tool, then obviously it can help you a lot, rather than if you're really in it to generate revenue, you're not really going to negotiate because you want the money, right? You're putting it there because you want the money. And then in the short term, it will stimulate your domestic employment. Okay. Now we'll talk about that a little bit later, but in the short term, may very well do that. Higher price, the biggest thing, higher prices for consumers. That's where it comes down to. That's who's going to pay it, is you and me and everybody else buying stuff. And unfortunately, it acts as a very regressive tax. So regressive means that you charge the people at the bottom more than the people at the top. And of course, people are like, no, everybody pays the same thing, right? And same thing with like a national sales tax or a VAT. People are like, well, 10%. If everybody just paid 10%, it's fair. But you understand, the really wealthier people, that making that $700,000 a year, has, a few tens of $1,000,000 in the bank. They may only spend, less than 10% on what they make on the things that they earn. And somebody on the bottom may spend, 70%, right? And so 70% of everything this person has is getting taxed 10%, and 10% of everything this person has is getting taxed. So you can see why that's regressive. Yes, maybe the higher income person pays more as an absolute, but this person is burdening more themselves and their families on these types of taxes. Okay. Of course, risk of retaliation. We're seeing that already. We are in a trade war right now. Well, we're going to see how it shakes out. And it's definitely going to mess up our global supply chains. Already has. Already heard truckers really starting to get unnerved because the shipping coming into the West Coast is almost dried up. And that was a lot of their work. is to drive those and distribute those around the country. And so what are they going to do? Beyond just the fact that we're going to start missing stuff off the shelves. I think China is ready to play a hard ball, and if they're willing to go all the way to Christmas, and you're going to have a much emptier under the Christmas tree than you would have had or have had in years past. And I think they know how American citizens and consumers are going to feel about that when it happens. So again, I'm not on their side or anything, but I definitely think we're absolutely shooting ourselves in the foot. It's not going to raise the revenue that we need, and it's hurting the people that probably need the most tax benefit. Okay, and you can see these other things in there. It does do those. So who's going to win? Who's going to lose on this side of the tax things? So who's going to win? Domestic producers that actually get protected by the tariffs. So right now, steel, aluminum, textiles, maybe some electronics, but not really as much, just because they have such intertwined like manufacturing complex structure. Governments in the short term, because we'll make some money from it, raising revenue. Labor unions only in the sector shielded from the foreign competition, and then politicians, getting the support from these people that win. And also, if we're just kind of pissed at all the rest of the world, then it's very populist that it seems good. Who loses? Consumers are the big number one. Consumers, because you're going to pay for it all. We're all consumers. We're the biggest consumers in the world by multiple times. So we're going to pay for this. I saw something that said, again, you get all these different estimates from people, but it was like, the average American was going to save something like $800 and some from the tax cuts that are going to go through. But with the tariffs that are already being collected now, we're going to end up paying about $900 more on average per person. It's going to be different for different people. And then if we actually implement everything that's on the books right now for next year, it's going to go up to $1,600 and some. So double the tax cuts to collect 1/5 of the tax revenue. Okay, so big loser are the consumers. The more you consume, the more you'll lose. Okay, exporters, obviously, we saw this with the China trade war of farmers and stuff back in 2017. You can see that again, or in a different way. Industries relying on global supply chains like the car, electronics, Apple. You see them saying, hey, let's switch to India or what so. You might see more onshoring. I kind of agree with multiple people I've heard that even if jobs come back here, or manufacturing comes back here, the jobs are not. The days of manufacturer workers having high incomes to produce stuff are over in the United States. So if you think that this is going to get, it's not. It's going to be robots and automation stuff that puts that stuff together when it comes back to the United States. And you're still not going to have a job, and those rich people are just going to be richer. All right, so let's look at this. And I like to say this, like, who gets left behind? And we start talking about, we can't tax, the higher income scale. I mean, like, they're not going to invest, or we're not going to have as many jobs, or the stock market's going to go down. And if you look at this, just the last, this is going, 40. Where are we at? 40. This one's 42 years. And just over this, the top 1%'s gone up 326%. And the middle class, basically, right here, has only gone up 73. I mean, hoorah to, the bottom who's made some better gains, but still, it's like 1/3 at the top. Okay. And so that they can't pay some extra tax is just crazy. It's absolutely absurd. Okay. And I can show you so many more charts. If you go back to like 2 webinars ago, I did go over this, so I'm not going to rehash it. But I still like to show you who's going to get left behind. Again, it's still going to be the middle and the lower class who have more, that are going to spend more of their money on living and not get as much of the tax breaks and what's so. Now, there's going to be some winners out there. Say you're, working in the steel industry or welding or, whatever, where you can get a bunch of overtime and they do the tax free on the overtime. You're probably going to have a good win there. Okay. But again, that's not the vast majority of people, right? So, somebody like, hey, this is going to stimulate the economy, right? If we give tax breaks and stuff, it stimulates the economy, it's going to help us get forward. But if you really look at the more that you give more to the wealthier side or corporations or what, so they don't tend to spend that money to buy stuff. They tend to save at a much higher rate. Okay. And if they've already got a lot more, they're not going to spend that much more. Okay. And so from that perspective, if we're giving more tax breaks to more wealthier people, it has very limited stimulus impact. If we do give more to retirees and what, so if we make the Social Security non-taxable or tax-free, it again is going to have a limited stimulative effect, because they're probably not going to spend more than what they're going to spend before. They might leave a little bit more in their retirement accounts. Maybe that helps the stock market a little bit, but it's not going to help necessarily the economy or anything broad-based for the rest of everyone else. And so beyond that, if we just continue to raise our debt to do things like this that, in my opinion, don't really matter that much, we continue to raise our debt to these high levels. And the next time something bad happens, or maybe the time after that, who knows exactly how much patience or balance sheet wealthy individuals in the rest of the world have to keep loaning us money. But we may not be able to borrow to stimulate or to bail ourselves out of the next bad thing that happens. So the policymakers are going to have fewer weapons to counteract. So we could get back, to pre, 1940s and all the way through the 1800s up to the Great Depression, 1929 to early 30s. We had huge boom and bust, and that's rough. It's really rough. Most people in the last 20 some years have not been through a real significant recession. And so, looking at this again, throw your questions if you got them. Looking at this, I just said, how's everyone feeling, right? And if you really see it, ever since the election, everybody is feeling no good, no buen. Anything below these lines generally means that a lot of these things are in contraction already. We just got the numbers out, negative GDP, almost 100% coming from the tariffs, jerking us from probably a pretty good positive to a negative. And just as David Kelly just said yesterday, the main thing that concerns him is how much the CEO confidence has gone down. And you see that in the fact that, if these businesses, big businesses, small businesses, don't feel like they can hire, or they don't want to spend on capital expenditures for the future, this is a huge thing. And so we could absolutely be going to recession already. We could be in it already and not even know it. Now, with all the immigration stuff that's going on, that's another thing that we were talking about yesterday, is we're effectively, we need something like almost 1 million more people coming in per year to really get us to where we need labor employment wise. And right now, with how they've so effectively clamped down the border and what, so we've almost cut it off. And if we're kicking out 250,000, to 500,000 per year, and let's just say we get in, couple 300,000 from the legal ways, like, we're not going to have enough workers, right? And so that's going to be inflationary, and who knows exactly what other collateral damage that can cause as well too. So, why so much doom and gloom? And, I'll almost go backwards, but uncertainty is so bad to not know what's going to happen. And we don't know the future. No one does, even in the best of times. So right now, it is like double or triple worse because we're doing so many self-inflicted dumb things. And so that's why so many people are negative right now, or the consumer sentiment is just dove, is because of this. We've got our tariffs and trade wars, and who knows how this is going to shake out, but more than likely negative. Okay. Immigration and reducing the labor force. People may be happy about this. They absolutely may have needed something done with how it had gotten out of hand, but it's almost like gone the reverse, right? Way too far for what's good for us. And it's going to have negative repercussions. We're increasing our national debt like crazy, and we don't need to. Like the economy was doing great. We did not need to do these things. We probably could have done some things to let the TCJA expire, maybe even tax a little bit extra and stimulated some business and lower income. I mean, if you want to stimulate, you just do what you did in COVID. You send people checks. They will go out and spend it. They're not putting it in their savings account. Most people will go spend that right away. That will stimulate the economy. But I don't even know that we need to do that even. Expansionary monetary policy. I mean, right now the Fed is holding its own and not lowering its rates for no reason, right? That's a good thing. We got to keep our inflation in check. They need to have their independence. But if we're going to have a good economy and let's say the executives allowed to, push the Fed into lowering rates, just we don't believe in higher rates, then you could have inflation going out of control like we did in the 70s and 80s. And so, if they lose their independence, even just the perception that the Fed is not independent could be very negative on the economy and the world's perception, and even our own financial institutions' faith in what's going to happen. And then, of course, geopolitical instability, Russia, Ukraine, Israel, maybe, hopefully not, China and Taiwan. Hopefully, we're kind of joking here, but Canada, Greenland, Panama, but you see, Canada has almost turned against us, which is sad because they're almost like our best neighbor of like really cool people. And it's like, what are we doing? And then I just put this in here. It's like, hey, Africa is usually a really hot mess, and they've been awfully quiet and decent for a while. So something could erupt out of there as well, too. So there is just a ton of uncertainty here. Okay. So I think about these things, and while I said that, hey, we're looking at tax decreases, I think you got to look at the long term. Eventually, we have to raise revenue. We have to start paying for some of the things we do. So we start thinking about some of that, right? And so obviously we have tariffs, which I would almost put in the same category, even though it's different than the VAT or sales tax. And that absolutely could be something. I mean, maybe this is a new thing. We're always going to have tariffs now, but maybe we can bring it down to 5 or something. I think the world's on average to us before this was a little over 2. David Kelly said yesterday is like, heck, if we just use this to get to 0.0, that would be terrific. And we would win from that. Like the markets would be happy, economies would be happy. It'd be terrific. But I don't think that's going to happen. Knock on wood, I think our best case scenario is 10% flat on there. But think about things. I mean, they already proposed this multiple times, to say, hey, let's raise capital gains up to normal income rates, because you could be at 0 to 15 right now, and you could be paying 24. Or if you're at the highest, going all the way up to 37. So that's huge there. They even talked about the more extreme of, hey, let's tax unrealized gains for certain things or people over certain incomes or whatever the case. And that could cause a lot to come due real fast. Estate death taxes. I mean, this is probably one of the more palatable ways to have a wealth tax because it's like, hey, we're not going to take your stuff until you're dead and you don't need it anymore. Right? Hey, you had it, you spent it, had your fun, but now, let's pass half back on to the next generation, and half, can go to your heirs. That's just the idea of it if you were to oversimplify it or what. So I could totally see that come back a lot harder and bigger because it is kind of the nicer way than the straight up wealth tax, which you say, hey, maybe a progressive tax, like an income tax, where they're just like, hey, if you have more than $20 million, you pay 2% of whatever you own. If you have more than $100 million, you pay 4%. If you have more than $500 million, you pay 8% or something like that. I don't know. Throwing ideas, because eventually we're going to need to pay for what we owe. And I think you're going to see income tax base actually recede if you see more automation, more AI, like we talked about with the onshoring. You got to find a new tax base, right? And tariffs are probably not going to cut it. So we're going to look at one of these. You can see one of the more progressive ones, like the first person I know that proposed it and was Bill Gates, to say, hey, instead of wealth tax, let's just put a tax on robots or automation that take people's jobs, right? It's just a tax that they have that goes back into the system to help people that don't have jobs anymore, or what. So looks like we got a question. It says here, it says, do you think the government may try attempting to inflate away our debt? Increased inflation should increase tax revenue or devalue our debt. Sure. I mean, like, I don't think that will happen purposefully. I'm not saying that we couldn't hit, for us, a hyperinflationary type period. But if you look back through history, whenever you've seen regimes intentionally or not intentionally pursue that or go down that road, it tends to be pretty devastating to a decent percentage of the population, in terms of their savings get eroded. You have a lot of people that have pensions and that they're not indexed to a regular inflation, and so they're just going to get pounded. And so it's a very harmful way to solve that problem, even though sure it's effective, just like Germany after World War One or but who wants to take a wheelbarrow full of money to go buy a loaf of bread and for decades become worthless over a few years? So I really hope not. For most of our history, for a long time, for the last 100 years, we wanted a weaker dollar. It helped us, and then all of a sudden, the last 10 or 15 years, we want a strong dollar for some reason, like it's like some national pride thing. And so I even think some of that would even stop us from doing that, because there's so many people that are anti to us devaluing our currency, even if they're not even thinking about it for the right reasons. So is a strategy, hopefully not one that we pursue though. Okay, strategies for long-term financial planning. A lot of these are our old go-to. So like tax loss harvesting. So if you're going to have a big tax year, a lot of times we can strategically sell things to create losses to offset gains. Helps a lot for specific people in certain situations. Making sure that you're buying investments that aren't going to cause a lot of extra taxes, but still have good rate of return characteristics for what you're looking for and risk. If you're charitably inclined, one of the best ways to be able to control your taxation is to give to 501c3s or where you can get a good tax deduction to offset some of the other things, maybe where you were very successful. Definitely be careful of concentration risk. So many people are so concentrated into large U.S. companies, like they don't have any or very much international or small companies, or they could be tech heavy and not into other industries. And generally, who knows the future? But generally, nothing is the best forever. You change in leadership, you have that reversion to the mean, or things getting back to their averages. And the S&P 500 and large US in general has just been on a tear the last 15 years. Could very, very well be on the chopping block for a good correction. So just be careful if you got all your eggs in one basket, or a lot of them. Be careful with leverage and variable interest rates. You don't know. I mean, we could be a lot closer than people think to some kind of big recession. I don't think this one will be that big, but I do think we're due for a recession. But eventually, sometime in the next 10, 20 years, I think we're going to have a whopper of a recession, near depression, where we can't stimulate our way out of it. And people aren't going to be used to it, and they're going to freak out and make it worse, because a lot of it is a feedback. So if you're too leveraged up, it's going to be harder for you to take that and hope, survive it. Even beyond that, though, if you're not leveraged up and you have savings, etc., you might actually be able to take advantage of it. Be strategic with your income planning, how you're investing and withdrawing from things in the right orders, depending on what's going on tax-wise, investment-wise, etc. You may consider accelerating taxation, since taxes are going to be low and maybe higher in the future. Maybe accelerating capital gains, which would kind of be the opposite of the tax loss harvesting, but may be really prophetic, 10 or 20 years from now. Roth conversions, And then I put some other things in here from another one that I did in terms of how do you exit from things that you built that are very successful, but also trying to help create value for future generations and your employees, and what so rather than just the stock market or private equity or what so. So I think I could probably answer a couple questions if anybody has any more. I think the main thing is with all that uncertainty and sometimes with chaos, kind of like what was that guy's name in The Fifth Element that had his corporation. He's like, I don't care if things get destroyed. It makes all the robots and the different things that I build make me more money. There's opportunity. Capitalism kind of is creative destruction, right? And so if you're somebody that can bob and move and kind of visualize all kinds of different potential outcomes, you may very well thrive in what's going on right now. Whether certain ideologies think it's great or bad, whatever, I think the people that will do the best are the ones that are keeping their minds open, take advantage of things. I hope that if you're very successful, you try to help other people and make our society better, and not just be another mega rich capitalist. But I think there are a lot of opportunities on top of the risks. Be prepared for it. Let me check the questions one more time. Otherwise, we'll get close to shutting it down. So, check out some of our future ones. Our next one's going to be investing in crypto. It's going to be a very practical one because I think I went over the basics of it. I've done some more complicated getting into the weeds of technicality, but this one's going to be more about how do you do it, where can you buy it, how do you build portfolios. Again, there'll be a lot of disclosures in that. We're not giving you advice. We're just trying to show you how. Should you? I don't know. That's for you individually to figure out, or get an advisor to tell you on your individual terms, but it should be a good one. If you know anyone that's in like Texas or Michigan or Ohio or California where they could be in some of these pension alternatives, let them know. We got that one coming. I'll throw the next live subject one on probably sometime next week because again I want to visualize it or think about it when I can do something that's really kind of new. Check us out in general, just on our main website. We do have a free level now in addition to all of our advisory driven, and check out our reviews and all the different things we do for people. Would love to be able to serve you as well. Let me know if you have questions. If you're watching this on demand and you put your questions in, generally I'll write you an email back or send you a video response. So we do care even if you weren't able to catch us for the live version, and we'll get you back some prompt good answers. So I hope you're having a great hump day on the week since we do these on Wednesday, and hopefully we'll cross paths and get to talk to you or see you in a future webinar sometime soon. See you then. Bye-bye.